So given we've got the Fed meeting over the next 2 days, thought it might be helpful just to kind of talk about some of the factors that the Fed is weighing coming into the decision. And if you scroll forward, Mark, a slide, or do I have the ability?
You have the ability.
Okay. They've been talking for a while now about being data dependent. And as we go through this, I think what you're going to find is there's still a lot of uncertainty around the data, and it's complicating the picture for them, and clearly, is making it, that uncertainty is flowing through the market too. You see it every day, and the movement of bond yields bouncing all over the place. So what are some of the things the Fed is looking at? Their preferred measure for price inflation is the PCE. And so what I have up here in the chart is the headline PCE, which you can see has started to trend down pretty significantly from the peak of last summer. And then the core PCE, which is really what the Fed is focused on, which strips out energy and food. It's kind of been moving sideways down, trending down a little bit, but still, even both of those numbers, the Fed is looking to get that price inflation number back down towards a 2% level, and we are still significantly away from that. So trending right direction, but an awful lot of more deflation is needed from the Fed's mind. Now, when we think about monetary policy, the general thought is historically it takes sort of 9 to 12 months for a change in policy to actually work its way through the real economy. So the Fed started their hike cycle in March of last year. So we're just kind of hitting that point where it should be showing up in the economic side of the equation. So what I did here is I took a look at the headline PCE, which is a year-over-year number, and then I took the headline PCE for the last 6 months on the idea of it gives a little time for that lag to hit, right? And I annualized that number. And this, again, being the headline PCE, you could see with the lag over the more recent months, a little bit more of a drop in the inflation numbers. And maybe that's showing us that as the lag plays out, that we'll start to see the drop in inflation coming, so price inflation. And you can see with the last 6 months annualized, based on the March number we just received, inflation running at 3.6 on an annualized basis, which is, working its way down. Now I take that same methodology and I apply that to the core number, and I think this is what has the Fed a little bit more concern is core inflation is it's definitely feeling a little stickier. You don't see that same drop that it had on the previous slide that you saw there. And when we think about it, the energy numbers have been coming way down, right? We kind of peaked in energy right after the invasion of Ukraine, and we've seen the price of a barrel of crude come down. We've seen gas prices come down. So that's reflected in the headline, but not in the core, obviously. So again, the view here is it's a little stickier, more stickier than the Fed would like on the core inflation number. And then when we look at the sort of the makeup of inflation, and we saw this play out, you can see the goods part of the price index has fallen dramatically over the last 6-7 months, and part of that was the fact that we the way it played out. We've all heard this story. We shut down production. We had some fairly significant restrictions. And it really funneled the purchases, and we also stimulated the pocketbook. So you had money to spend, you could only spend it on a few things. So you had a supply-demand imbalance in goods that is, now unwound itself. The Fed's more concerned with that services number, as you can see, has stayed, elevated here. And there's a question of whether it's turning down. We got a little bit of a turn down on the last reading, but not enough to say a trend is in place. And that's really what's got the Fed concerned. Remember, the service economy is much larger than the goods economy, something to about 70 to 30, 65, 35 sort of split. So that's the number that's got the Fed, again, weary, trending potentially in the right direction, but clearly not, definite evidence that it's going there. So the price indices are mixed, I'd say. And then we move to the other thing the Fed's concerned about, and that's wage pressures, the labor market. And I have up here the employment cost index. Again, you can see the run up and it kind of plateaued, and it looks, again, our last number again was a notch down, came in a little lower. And so potentially we've got a trend here where cost pressures are easing. The JOLTS number, which I think came out at 10 o'clock today, I didn't see it. But the prior months you saw the JOLTS numbers fall. So a little bit of a narrowing of the tightening of the job market from that perspective. Saw payroll slowing a little bit. But again, at an unemployment rate with a 3 handle on it, it's still a concern. It's still a tight labor market, and again, the Fed's worried about that wage pressure. And think about this: another thing that's added to that, we just had a bump up in Social Security payments of almost 9% this year. So a lot of spending power still out there. That could keep inflation elevated, and again, a major concern for the Fed. And then the last thing I'll touch on is sort of a new worry, which is financial stability with the banking crisis that we went through. And we can talk a little bit more about this, but this is showing you the stress in the market from a standpoint of the usage of the bank facilities that are in place. It's the discount window and the term funding program. And initially after Silicon Valley, we had a big bump up to $165 billion in borrowing at the Fed. That looked to settle down, in the following 4 weeks. Those numbers started to dissipate until recently. And obviously with First Republic, we've seen those numbers bump back up again. So this is something, we'll continue to watch as a barometer of stress in the banking system. But clearly, I know Jamie Dimon said yesterday, we're out of the woods here. I think it's a little too early to make that call. We'll continue to watch this. I don't know if Stephen shared this with you guys on prior calls, but it was a brewing problem, the notion of uninsured deposits in the system. There was a lot written about Silicon Valley. 90% of their deposit base was uninsured, but more broadly across the banking industry itself, coming out of the financial crisis, insured deposits outweighed uninsured by a tune of 1.5 times. So the bulk of your deposit base was insured within the banking system. By 2014, they were basically even. About 50% of your deposits were insured, 50% uninsured. And that continued to then drift wider, where uninsured became a larger and larger portion of the deposit base in the banking system. And it really blew out during COVID and the aftermath, to the tune where now uninsured deposits in the system are running about 1.5 times insured deposits. And we're talking about $18 trillion deposit base in the banking system, 10.5 of it being uninsured. So the system looks a lot different than it did historically from that perspective. And then you add into the fact we had, a decade of zero interest rates or very low interest rates. And, you had, unfortunately, some bad bank management really stretching for yield, extending maturities, at the wrong time. And then you add on to that, the Feds, the pace at which they raised rates and the magnitude to which they raised rates was unprecedented. And it was almost the perfect storm for the banking system. So we'll watch it. I think, we believe what the Fed did was with the term funding program was the right thing. It basically buys time for the banking industry to kind of settle in here. But with all that, it's as I said, mixed signals. Our take is, we think the Fed does a 1/4 point here, and then if trending in the same direction that we are on the pricing and wages, we think the Fed should pause. We think they will pause, all things being equal, but we do think we get another 1/4 point out of them Wednesday. And with that, I'll leave it at that.
Thank you, Sean. What questions?
Yeah, Sean, first of all, this is just between us. Did you see the weather at the Masters?
I saw the tree go down, Andy.
Yeah, so we caught it pretty good. I was thinking like that wasn't us. Anyway, the sidebar story. The real question though is the PCE peaked June 22.
Yeah.
Sure, it's come down. It's not low, but it's come down. But at the same time, June 22 rates were almost zero. So now you've got rates up to the point where, for the first time since all this started, real interest rates aren't hugely negative. They've crossed. So
Yeah.
I'm reading between the lines, and you guys probably read between the lines more than I do. Does anybody care? Is anybody looking at this? Does this matter? Because everybody's just talking about a number, but one of the numbers is real interest rates have gone from being hugely negative to not being negative. What do you think?
Yeah, and if you look out, Andy, right, so the 5-year break even, that's the market's pricing in a 2 handle on inflation. So what the market's telling you is this trend will continue and potentially accelerate. But yeah, the market believes that you're going to see that happen, and is part of that driven by a recession from the market's perspective? Yeah, without question. But yeah, the real rates as you look out on the curve are based on the fact that they've seen inflation coming back in.
Because I guess my question was also, that's what the market price is in. My question was more steered to, is some of the heat off the Fed to keep raising rates?
Correct. Yes. Agreed.
That's what I'm, that's really the read between the lines question.
Yep. Agreed.
Adam Blanco?
Yes, my question regarding the uninsured deposits and that trend from the difference between insured and uninsured deposits. What's the solution? Much of this is really psychological.
Well, I think you'll see the FDIC. You'll see that level like at 250 now of insured up to 250,000. I think they've got to bring that number higher, and I think they will. That's part of it. And as an investor or as a depositor, to be honest with you, there are programs in place right now where banks basically share their insurance, right? So you can go out, insure $1 million at one institution because they're actually parsing it out within the network, if you will, so that they can get 250 here, 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 and there. So it's really easy to insure $1 million of deposits today. So part of it will be the depositor base will kind of wake up and say, I gotta think about this and do it. And I do think the regulators will bump that number up to a level that's higher than 250.
Now, the 250, sorry, one more last question. The
Yep.
250 number was brought in, if I recall correctly, that was in 2009, right? 2008, 2009?
It was, I think
It wasn't
just
that long
after-
ago.
Right, it was just after the financial crisis, they bumped
Right.
it up. The
So my
250.
question is, the market's changing a lot, and a lot of these changes are permanent, at least long-term, maybe not permanent, but long-term. Point in case is the real interest rates. We have real interest rates now for the first time in what, 2 decades, decade and a half?
Right.
So where is that deposit insurance number, and how do the regulators change the mentality of the general public in terms of the risks they're taking? It also points to a lot of liquidity in the market. I said a lot there.
Yeah.
But
How do
my
you
main point
change?
is regulators catching up with the changes in the market.
So the
That's-
regulators have to catch up, and I think they will. I think, again, from a standpoint of the issue that banks are facing with deposit flight. And it's just a piece of it too, right? I mean, what happened at Silicon Valley was not just about uninsured deposits, it was about a couple of other things as well. But going back to, I think there will be a change from a regulatory standpoint. Listen, the economy has grown quite a bit over that period. As you mentioned, liquidity now they'll pull some of that liquidity down, but so they have to adjust to that, and I think they will. From a consumer standpoint, part of that will be driven by the providers of the product, right? So if I'm in the banking industry, I want to hang on to deposits, these programs that I just talked about, where they can actually leverage the system to increase that particular consumer's insurance across broader than the 250, that'll start to come, I think, to light, and they'll start pushing it out to their client base in a much greater way, so that I think it's multiple things. It's the consumers, it's the provider of services, it's the regulators will all have to adapt to what has happened across the deposit base. Ultimately, the banking industry is built on trust, and the model is you're borrowing short and investing long. There's a natural mismatch in the duration in the banking model, and it only works if capital is sticky, right? You could argue that JP Morgan would be in the same spot if all of their depositors decided to run.
Yep.
Right. So eventually we'll get back to trust in the banking industry itself, and then there will be changes from a regulatory standpoint, and again, I think from a service standpoint and the consumer standpoint as to how they bank. It'll just take some time to get through it. And again, would we be surprised if we have some more regional bank failures? No. And I don't think it becomes systemic unless we have a broader breakdown of trust throughout the banking industry. And I don't think we're there. I don't.
Thank you. Great presentation.
Joe Zaro.
Hey, Sean, great presentation. Curious what your thoughts are. If you don't think that this is going to be kind of a wider, thing, and it's going to be kind of contained to some smaller regional banks, do you think the banking sector is something to, is it on sale right now? Is it something that you would want to have a larger exposure to, or are you guys kind of cautious on that? And is it better to just play it safe?
We're cautious on it. And Joe, we haven't been big in the space even prior to this. So what's going on with the banking industry a little bit longer term? Again, they're gonna, credit standards are going to tighten, so loans are going to drop. We think that hits profitability of the banking sector in general. I got to believe insurance costs are going up for banks, will be one result of this. So we're not, bullish. We don't really think, it's, and the other thing, it's hard to know what you have, right? I mean, the larger banks do a lot more than buy treasuries, right? So it's a very, esoteric asset base that you're dealing with it as well. But in general, we think, again, costs are going up to run a bank, which means it's going to crimp profits. So it's not something that we'd be jumping on, particularly going back to your question on the regionals. Too early to know sort of how this is going to shake out for those guys. The JP Morgans of the world are going to be fine. But even there, do costs start to run up in them? Do they, pull back again on lending? That hits profitability.
All right, thanks.
You bet.
Other questions, comments? I was looking at you, Paul Mangione. We've been talking about institutional, how the institutions are trying to play these markets. You came from banking. You have any comments?
On the banking side, I think there's just going to be a lot of review of balance sheets internally and externally, as investors, as depositors will potentially move and banks need to sell assets. So I think we're going to see more asset sales, whether hopefully controlled, but maybe more, uncontrolled. So, I think the focus is going to be on, asset sales from either people preparing for a review or after they are reviewed by, their regulators.
Fair enough.
And Paul, you might make the argument that from the Fed standpoint, they want to be careful about, again, rates moving higher, impairing that balance sheet, those asset sales even more, right? So that's got to, again, one of the things that I think they've got to be thinking about.
Yeah, I think maybe one question I have, you go to slide 7, you were talking about employment. I mean, the Fed has this dial of, that was employment costs, but I think in general, they have this dial of, they can turn up interest rates to lower employment, but it's not, it's a 18-month feedback loop. So,
right.
Like I was reading some stuff in the journal yesterday about it, like the feedback loop could be up to 18 months. So when do they decide, it's time to stop? Because, it's kind of like if you, when you're moving the mouse and the computer is like backed up and it's, you got to stop at some point to let the mouse catch up.
Yeah, and to your point, you get too data dependent, and if that feedback loop is 18 months, the first rate hike hasn't even hit, right? We're 12 months, or I guess we're 13 months out now on that first hike in March of 22. So yeah, I mean, it's I wouldn't want to be at the Fed. That's a tough balance.
I was focused on the construction industry. It looks like it hits the construction industry a little more rapidly because of lending, but that's those kind of industries, it hits not immediately, but a little faster. But the general population, it's kind of a much slower response, and so we may be at the point where they don't have to do anything else because it's just, but they have to just wait and let's see the results. They haven't seen the results yet, like you said.
Yeah, and we'd be in that camp. We'd love to see them pause here. I don't think they do. I think they do another quarter. Some have made the argument, and I apologize for that, but some have made the argument if they don't do a quarter, that then that kicks in a fear factor because it must be worse than than it's being thought about in the banking system, right?
Yeah,
But-
and then in regards to banking, maybe just to cover maybe what Mark also had me kind of like come up is there was a good interview from Mark Rowan at Apollo talking about private lending and really and the banking sector, and I think you're going to really see private lenders come up and fill the void, obviously at higher rates.
Yeah.
But forced, not for agency
Mhm.
mortgages, but for all other kinds of lending opportunities, private business C&I loans, the kind of loans that banks can't do anymore because they've tightened so much, that you'll see private lenders in the form of institutions, either backed by them or owned by them, kind of provide the capital in the places at higher prices, at higher rates. I mean,
Yep, without question.
yeah, but that's all I have. Thanks.
Thanks for that. I knew you'd have a point of view. Andrew, you're back.
Yeah, actually, I just wanted to follow up on what Paul was saying, is that this might be a worthy topic for a session, is just to summarize what's going on. The amount of money being raised for private lending right now is absolutely massive. The stuff in the works, the stuff they have, I mean, it's literally so massive, they're literally replacing the banking system. And this is going from 10 years ago being a niche strategy, is now literally a dominant strategy. And Paul, I have no idea what the impacts of this are, because it's outside the banking system. So you have investors, pension funds, whoever, that are holding that risk, for better or worse. There's nobody backing them up, and the people, the Blackstones, BlackRocks, whoever of the world, the Apollos, with those funds, they're asset managers. Their balance sheet's not at risk. They're not at risk. Only the investors are at risk. So it's a very different situation than we've ever seen.
The benefit is that, let's say in 2008, that private lending or private capital wasn't up and running. It was developing, and it was coming from 2008 to 2010 is when it really kind of grew. Now it's it's already like all the infrastructure's in place. People have been maybe waiting for a long time. So the good thing is that you won't have these uncontrollable kind of sales or roll-offs, or like there's a lot of capital there that kind of come in when the levels meet their objectives, versus 15 years ago when you didn't have all this infrastructure, firms, systems, mark-to-market processes, just to have a fund that doesn't really have public. I was talking to an investor yesterday, like they need to have third-party marks. Like if you own some of these opportunities, these investments, you have to, it's harder to get, there's no public market for loans in the way there is for stocks, that you could get a very clear price every day. So you got to make sure you work out that process.
In fact, 06, 07, direct lending melted down. There was the Pedders fraud. It was a train wreck even before the credit crisis started. So it really wasn't until zero rates started to become entrenched in 12, 13, and 14 that this started to grow, and it's taken off like a moonshot. So anyway, sorry.
So Bill, you question?
No, I wanted to follow on Andy's point. It is crazy. According to Preqin, back in 2010, private credit was like 250 billion. Now it's expected to be 1.5 trillion by the end of this year. So it's absolutely nuts, how expansive it has become. I guess on the good side is that it's filling, as the banks retreat, it's filling in. So as far as business is concerned, it's not like credit is disappearing. It's just being provided through another avenue, albeit on more expensive terms. So that's positive and a negative.
And
But
Paul,
at the same time, yeah, I mean, as it becomes more, is that the new systemic issue that we have to think about? But, I think overall it's sort of positive. These guys are very entrepreneurial about it.
Bill, it is because the risk takers now have no alignment with the debt itself. There's no consequence to them. Whereas a bank,
right. Bill, just on a side note,
Yeah.
take a look at the chat.
Yes, yeah, I responded back to you.
Oh, you did? Okay.
I did. Take a look.
Yeah, was the answer yes?
Yes.
Okay, good.
Yeah.
Right. With
Just
that
take a
one-
look. You'll see.
Thank you. Andrew.
Can you guys hear me? Yeah, okay, it looks like my mic is okay. There's a lot of people going into private lending right now. Many of them came out of the banking sector. One thing that they don't have in the private lending space is anyone who knows how to do workout. Nobody's gone through a really bad credit crisis in this space. And a lot of people in the banks actually say that they've got nobody who's seen a real cycle. So when there's a bad credit, somebody who doesn't have a bank and a bank infrastructure and the bank relationships where you've got the bank accounts of the business, for example, or the property where you're not entwined, a private lender doesn't have, what are they? They've just got to sell the asset. They don't really have as much, capability to actually work it out and make the asset better.
Well, it depends on the shop, right? Because a lot of these private lenders have been doing that. They've done loan to own, they've done workouts, but the new shops, maybe to your point, yeah.
Yeah, well, a lot of these since 2014, it's exploded. I mean, it's quadrupled or quintupled in that amount of time. And there hasn't been a crisis because the government bailed everybody out in the pandemic. So there were no workouts at the end of the day. There were very few. And anybody who has gone through work, it's not the same as underwriting.
and Andrew, some have no motivation to work it out. 2 weeks ago, Brookfield defaulted on properties the same time they raised $100 million to buy commercial properties. Same week. Both.
Right. They'll walk away from asset A and buy B,
Exactly.
or maybe they'll buy A again through a different sleeve.
You just hope they're the same investors because sometimes they're not.
You can't do that.
I know, Paul, but this is we've seen some strange things happen. Not Brookfield, but Paul, what we're seeing in the market, I think, with our private credit, niche private credit is finding niche-y loans and the institutions want to take them down instead of giving them to their to the chance they get to the LPs. So it must be just an avarice for deal flow, or at least the kind those niche funds have, Paul. But you want to comment on that?
I mean, I think one thing is just that rates got to a point that, well, first there's more capacity as a loan versus as a fund, right? Like JVing in someone's fund versus, these large institutions can't invest in people's funds typically, unless they have some specific fund of funds mandate.
Right.
So they could buy a direct loan, and because they'll have a program to do that. So it's not that I think the fund, the originators that also have a fund want to take it away from their LPs. It's just if they want to do a large investment, they need to sell it as a direct loan versus an investment in the fund. I mean, I think there are opportunities to JV, like that you could set up a joint venture with an originator that maybe has a good track record. But a lot of the times they just generate a flow program where they sell into one of these originators on they have some quarterly or annual quarterly annual hurdles to hit in terms of volume, and they will turn on a flow program for some of these private lenders.
Right. Just so everybody knows, Paul and I partner on some private credit mandates, so that's why we see the market together. Any other questions, comments?
I guess, Mark, to that point, and on your private credit mandates, for these PIK holdco notes and different kind of preferred structures that you're seeing replace traditional senior, where are you seeing? I mean, 12 to 15%, obviously, but kind of, are you seeing people opt for fixed or floating, as they come in with these PIK holdco notes?
Well, it depends on the asset and the strategies. But there's Paul, do you want to speak to that and go around some of the?
I don't have a good sense of fixed versus floating. I typically see investors, they like a fixed asset because they, don't want to have the additional risks of in terms of, volatility and rates, whether rates go up or down. I think they just know that the yields are high enough that they'll be comfortable to maturity on the asset when they're in that 12 to 15% range. There is a lot of public, public securities that I don't really want to get into kind of talking about them, but that have that are now at levels, they were discount assets and they were a floating rate, and so now they're at high yields as well, relatively high yields because they're at a discount and they were floating rate, so they have the higher index. But I think most of these institutional investors, I think they're comfortable with just doing it as fixed, US based, dollar based. I think maybe non-US probably have different view on that, but the US based teams focus on fixed rate yields.
We have a bridge loan fund, Dave, that is really well placed. I mean, that's obviously not an issue, right? Because it's just a 6-month, 12-month, 18-month. That's been really popular.
Well, I've been working with some of these larger institutions, and I think that, they're the counterpart, like you'd rather not be a bridge. I mean, if you could get yourself in right now, replacing senior or replacing a piece of a unitranche loan at 12 or 13%, ideally you'd have 4 years in there. And I think a lot of the lenders I was talking to, CDPQ yesterday, what they don't want to do is underwrite an asset, put $300-400 million into something, and then be taken out in 18 months when rates come down.
Right. No, I was speaking about a deliberate bridge loan program, but in the regular way, you're right, 100%. Any other comments?
Yeah. Hey, David. If you're talking to the big guys, I'm curious if they have any heartburn over the fact that so much of this lending is going after private equity sponsored companies, because to me that seems like not a great place to be putting a ton of money right now.
Yeah, I think that the money that is being raised in these holdco PIK notes specifically, like I think we have 50 active mandates in our credit advisory group right now, and the majority are becoming this type of transaction, which is delevering a business, and it holdco PIK note doesn't count towards your fixed charge coverage. They're getting a higher interest rate than they would, they're getting kind of like what Mezz looked like 2 or 3 years ago. And their own, their detach might be at, below 50% of enterprise value. I think that being an LP in a private equity owned business, I'd be very nervous about this structured capital coming in, because it's at a lot higher cost of capital for a longer period of time. But I think the big guys that we're talking about, that they are, at the same time nervous about the private equity programs and what their, how legitimate their marks are, but also excited about this opportunity to deploy, Mezz-like returns or junior capital-like returns with, senior debt-like leverage from a year or two ago. And like, I made the point, because, these are either entirely PIK or majority PIK, or a PIK, cash PIK toggle, they generally are alleviating a lot of the concern on the balance sheet. And really in this environment, it's only businesses that have been able to grow and successfully pass on, increasing costs to their, to their customers. So these are, businesses that are growing with healthy EBITDA margins that are raising this type of debt right now.
We're gonna have a private credit deep dive and very shortly. In fact, Paul's gonna be one of the moderators. And if it's anecdotal, but I would maybe we could add it to the survey, Bill. But your two big insurance companies have created platforms to go after the non-sponsored business, and one plans to put 5 billion out. More like these, basically the market that the private equity doesn't usually touch, or they just, even if they do, they don't want to work with sponsors. They want to go direct, and could be anecdotal. Other comments, questions? Pregnant pause.
Anybody else not know what cash pick toggle means?
I apologize. So this is just a flexibility that allows a company to either pay an interest payment in cash or essentially issue a note, a payment in kind that sits on, allows them to defer that payment to a later date. So it essentially just compounds and accrues, rather than having to pay it in cash at the time of the interest payment is due.
Thank you.
Maybe Bill can add a question on his survey. How many bank sales or restructuring, bank failures in quotes, do you see by the end of the year? I think